Hello everyone. It's almost been a month since the last Monetary Policy Committee decision was given. It was on 7th of Feb. On that day, the bond markets perceived the monetary policy guidance to be less hawkish, which is why we saw the 10-year government security benchmark yield rally on that day by about 8 to 10 basis points. We were at about 7.6% levels, just ahead of the monetary policy, post which markets were trading at around 7.5%. As we speak today, almost a month into the monetary policy event, the yields on the 10-year benchmark have gone northward to about 7.75%. So almost pre-policy to current levels of almost 15 basis points sell-off. Now, what has really triggered this sell-off? From an event perspective, nothing very dramatic. Clearly, the outcome of events, both globally and domestically, have been broadly in line with expectations. Inflation data has not been significantly for the better or the worse off. We saw the recent GDP data, which also came in at 7.2%. Again, nothing untoward in terms of negative or positive surprises. Global yields, specifically the US, have been largely range bound, maybe some upward bias, but again, on balance, in India, we're seeing the continuous spiraling of yields to probably denote the fact that there is absolute lack of demand for buyers in the government bond market, and more specifically, when the new financial year's government borrowing commences, who would really absorb the kind of supply that is likely to start hitting starting the first week of April. So I think that excessive, I would say, anxiety pangs are spilling over to the bond markets, which is why we are seeing the yields as they stand right now. Additionally, this being the classical year-end, month-end, quarter-end, all coming in together in the month of March, there has been a tightness on the liquidity front, which is why the RBI has also been conducting repo operations to inject some liquidity into the system. Going forward, we believe that the Reserve Bank will continue to use the liquidity tools to ensure that there is no deficit liquidity in the system, because that could be an additional factor which could choke bond yields not only at the longer end but more specifically at the shorter end of the yield curve. Going forward, we also believe that unless there are any strong demand levers visible for the bond markets, the yields could continue to remain at elevated levels. Ideally, yields at 7.75 levels should actually stoke some element of buying. So the value buyers should ideally step in. But unfortunately, the foreign bond limits or the foreigner limits for India debt is full, which is why they are on auction mode. So we are at the mercy of auctions for incremental foreign demand. And secondly, the public sector banks are clearly conspicuous by their absence. Left to the mutual fund and the insurance sector alone, it is very difficult to expect to clear the government bond auctions starting April on a week-on-week basis. So I think to put the big picture into a nutshell, expect the domestic bond yields to remain elevated. We don't really expect continuous sell-off from the current levels, because incrementally the bond yields are tending to oversold levels, or maybe discounting rate hikes already too soon, too early. The shorter end of the yield curve also remains elevated levels. We expect some moderation probably by the end of March and going early into April, as the liquidity situation will normalize. In such a scenario, we continue to find favor with fixed maturity plans as yields on the corporate bond side are also at elevated levels, which allows for investors to lock into the relevant residual maturity of the fixed maturity plan. They help you mitigate interest rate risk because we just buy into assets, fill it, shut it, and forget it. For those investors for whom liquidity is also of paramount importance, we would recommend corporate bond based strategies, credit accrual funds to again put on money at the current elevated levels and ride it on for the next 3 years, given the fact that these strategies usually are maintaining low duration on the portfolio front. Should investors at this point in time look at gilt and bond funds? The answer is yes, only if you are willing to ride out the volatile journey, number one. Number two, are not excessively worried about the immediate near-term reaction to bond yields, number two. And second, are willing to expose the portfolio to a slightly higher duration. So risk reward, if we were to assess on all these parameters, core allocations should still be towards short-term and accrual-based strategies, and maybe some fringe allocations, or as we say, tactical allocations at maybe when yields rise or sell off further could be considered into duration strategies like gilt and bond fund, but very selectively. To conclude, we expect bond yields to remain a little bit on the sensitive side, little bit on the higher side through the remainder of the month of March, and only demand levers or guidance towards that could lead to some easing in the months going forward. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.